wait for a close above the previous day's high, like occurred right here with this green candle, but only after the percent K is below 40. So in other words, I want the percent K to start dropping once we're in the position to below 40, and then I start looking for a close above the previous day's high, which occurred here. So this would have been a dramatic gain on this trade. Now let's stop right here and go to a good options broker trading platform and take a look at put options. Okay, here I'm at the Options Express trading platform looking at the option chains for OKE. And this is the current pricing of options with OKE trading at $38.92. So what I've done is I've typed in symbol OKE. I want to look at puts. I'm looking at the November expiration because that gives me at least 45 days until expiration. I click on View Chain, and that brings up the options table. Now, because in this case OKE is trading at $38.92, I want to trade a 1 or 2 strike in the money option. That means an option that is priced with the strike price above the current selling price of the stock. For example, $40 option. And for this option, you can see the bid-ask price, $2.80, $3.90, which means that if you're buying this option at the market, you're going to have to pay $3.90. If you're selling this option at the market, you would have to accept $2.80. But when you're placing an options order to buy, you never want to pay the asking price. And you won't be able to buy it at the bid price, but you can usually buy it in the midpoint between the bid and the ask. In this case, about $3.30. Now let's take a look at, well, why not buy a $30 put? You only have to pay 10 cents, 50 cents, or they split the difference, 30 cents. Why pay all this money when you can buy one for 30 cents? Because the 30 strike put is what you call an out-of-the-money option, meaning in order for this option to have real value before expiration, the price of the stock would have to fall from $39 all the way down to well below $30. That's not likely to happen, and that's why this option is priced so cheaply. This one, in all probability, will expire worthless. So you don't want to buy that one. We want to buy the 1 or 2 strike in the money, and here's why. Let's click on Calc, and that brings up what is called the trade and probability calculator. So here's our symbol, our month, our strike price of 40, put. Let's say we want to buy one, and let's buy it at, say, $3.30, the midpoint of the bid ask, and click calculate. Now that brings up what's called a risk curve. This shows you the relationship of the profitability of the put option versus different stock prices. Right now the stock's at about $39 a share, and we had to pay $330 for this put. Now the November put option will expire the 3rd Friday in November, and if the price of the stock's trading at $40 at that time, this option will expire worthless. If it's trading at $41, it'll expire worthless. Anything above $40 will cause this option to expire worthless, and you would lose $330. On the other hand, if the stock at expiration was trading at $36.70, this option would break even. Why? Because it would have $3.30 of real value. $40, which is the strike price of the option, less $36.70, the price of the stock, is $3.30. Why? Because when you buy a put option at $40 strike, that gives you the right to sell the stock, but not the obligation at $40. So if the stock's trading at $36.70 and you have the right to sell it at $40, that gives you an option with real value of $3.30. Now, if the stock's trading down at 34, now your option's making good money and you've got a profit at $264. If it's trading at $30, you got a profit of $621, almost 200% from the $330 you paid for it. But it gets better. This is the risk curve at expiration. Here's what it looks like the day you buy the option. That's the green line. Because the day you buy the option, it not only has real value, it also has time value. For example, with the stock trading at $38.97, you buy a 40-strike put option. It has a real value at that time of 40 minus $38.97 or $1.03. But you paid $3.30 for the option, so it has additional value above the $1.03, or in this case $2.27. That's time value. But that time value erodes as you get closer to expiration, and that green line will collapse into the blue line. So when we put the option on, it's the green line that's operative. Now, in order for us to make money, the next day, if that stock trading at $38.97 dropped to $36, which it could, you've suddenly got a $133 profit, or about 35% of what you paid for it. And if it kept dropping down to 32, now you're looking at a very big profit. $411, now you're over 100%. Now, if this trade takes a week or two to develop, and most of our trades, we're going to be in a week to 3 or 4 weeks, this is what the green curve would look like. You see, it didn't really drop that much. And so we get profitable a whole lot quicker than you would at expiration, as shown here with the blue line. Now, if the trade goes against us, the stock starts to go up in price instead of down. As soon as the value of that option drops 50%, right about there, you get out. Take your loss and go on to the next opportunity. Now, I hope you notice something looking at this curve. You have almost unlimited upside all the way until the stock goes to zero, but you have very limited downside. The stock could go to the moon and you could not lose more than $330. And you only plan to lose half of that. So with options, you have the power of leverage, but you also have limited risk if you buy the right option. In this case, a 1 or 2 strike in the money option. Do not buy the out of the money option. It's a very cheap option to buy, but it's cheap for a reason, because it's very likely that it will expire worthless and you would lose the entire amount you paid for it. Okay, while we're here, let's go back and look at a call option. Okay, I just type in calls, hit view chain, and that brings up my call option price table. And let's say I wanted to buy a call option because my trading method told me that OKE is likely to go up. So what do I want to do? I want to buy a 1 or 2 strike in the money call option, which would be a strike price below $38.91. So in this case, I choose the $37.50 call option. That's 1 strike in the money. 35 would be 2 strikes in the money. 32.50 would be 3 strikes in the money. 1 strike in the money in this case is fine. So here's my bid ask, 230, 310. Now this bid ask, both on the put and the call in this example, is wider than I like. I usually don't want to see this bid ask spread more than 10% of the bid price. So when you encounter this, it's very important to never pay more than the bid price between the bid and the ask, so that you're not overcharged for the option. Okay, so let's click on the calc button, and that brings up the trade and probability calculator for the call option. So let's buy one at $2.80, which is the midpoint. Click calculate. And that brings up the risk curve for a call option. And notice it's the opposite of the put option curve. The put option curve extended down here and then went up to the left. The call option goes in reverse. Why? Because when the price of the stock goes up, the call option is going to gain in profitability. If the stock price goes down, the call option is going to lose in price, but only to a maximum amount, in this case $280. And likewise, the day you buy the option, it's the green curve that prevails because you still have time value in the option. And as the price of the stock goes up, you have the opportunity to make a great deal of money in a relatively short period of time. By the way, unless you're deep in the money on your option, it's a good idea to sell your option the first week of the expiration month, because the expiration month will decay the time value of that option rapidly, and that green line will collapse very quickly. So you don't want to hold the option that long. On the other hand, if you're deep in the money, meaning the stock has gone up a lot, then it doesn't matter much. You see the green line here is right on the blue line anyway. Most of the time value's already been pulled out of the price of the option. Okay, armed with that background, now let's go back and look at our chart example, applying our simple trading method for more opportunity. Okay, back to our simple trading method. This was the trade we initially reviewed, and now the market rallies. The 50-day moving average is still going down. Market rallies, the percent K is now above 60. It's at 80 something. And we wait for it to drop 5 percentage points. 80, 80, 74, right there. So we go ahead and buy a put option right there with the stock trading at $45, right in there. We wait for the percent K to drop below 40, and as soon as we get a close above the previous high, we get out. So in this case, you would have made a little money, but not much. But that's okay. You go on to the next opportunity, which is right in here. The percent K is above 60. It peaks at 86, it drops to 76 right here. You go ahead and buy your put option, and the market initially goes against the trade, but it won't stop you out. The put option will not lose 50% of its value with a counter move like this. Then you wait for the percent K to go below 40 and a close above the previous high right here, and you can sell your position with a very nice profit. Now, you don't have to wait for the exit rule to close above the previous day's high. You can sell your put option anytime you want. In other words, if it achieves about an 80% gain from what you paid for it, a good practice is to sell half, and then let the second half ride until you get the exit signal. Okay, here now we've got the market trading above the 50. We've got the percent K below 40, because now we're looking at buying a call. And again, I want to see the percent K change by 5 percentage points. It's 30, it's 25, it's 47. Let's go back and check it. It's 40, it's 30, 25, 47 right there. So I can go ahead and buy a call right in here. Now let's just check it. That price is around $47. You'd be buying a 1 or 2 strike in the money call. In this case, either a 46 or a 45 strike call. Okay, now you wait for the market to rally. You can take your profit right in here. You can wait till the close below the previous low right there. And here you can finesse it a bit. If you don't have a big run up, you can sell half here, hang on to the other half, and wait for a final leg up. and sell for even more. So that takes a little bit of finessing and experience, but if not, you could have still sold here for a nice quick profit. And you notice, I don't know, how many trades have we looked at so far? 1, 2, 3, 4 already for just one stock in a matter of a couple of months. So you can imagine how many trades there are available that set up according to this method when you look at the over 100 stocks that meet our stock selection criteria. So it'd be very easy to be able to average at least 2 new trades a week. Okay, then again, if you missed that trade, the stochastics came down below 40 to 36. You got 5 percentage points higher. You could have bought a call option right on the open there and sold it a couple days later for a little bit of a profit, not much. But you notice we're not waiting around. If it doesn't move in our favor right away, you just take whatever you can and get out. Okay, now the percent K is trading below 60. The market's above the 50 red simple moving average. Stochastics jumps more than 5 percentage points right here. You could buy the call right in there. And in this case, you would be closing out your call for 50% loss. But that's the first one like that out of several trades. Okay, that's going to happen on occasion. There's no way around that, but that's fine, because we know the odds are in our favor. Okay, now the market's below the red 50. The stochastics is above 60. It drops 5 percentage points right there. You buy a put option now because we're looking at the market going down. We're below the 50. And you can see this trade following the exit rule to stay with it until you get a close above the previous day's high. You wouldn't have got out until right in here. This trade would have made probably about 300%. Keep in mind, we're not applying any other criterion. This is it. And look how these set up for you. Okay, here's another one. You'd buy the put right in here. You'd be out here for a small profit. But you'd buy another put here. You'd be out here for a better profit. This one here didn't go above 60. This one 59.68, close enough. You buy your put here, out here for great profit, and so on. All right, let's look at another stock. Okay, this is stock symbol MU, Micron Technology. Again, compliments of free stockcharts.com. Okay, here's our red 50-day simple moving average. The market rallies, then sells off. Our percent K drops below 40. Moves up at least 5 percentage points, and we go ahead and buy a 1 or 2 strike in the money call right here. With the stock trading at 32.75, we'd have bought a 32 or a 31 strike call. And then following our exit rule, the percent K has to be back up above 60, and we get a close below the previous day's low, and you could exit right there for a really fine profit, triple-digit profit. Again, the market sells off but stays above the 50-day moving average. The percent K drops below 40. It ticks up 5 points right in there. You could have bought a call right in there and exited here for a more modest profit. But consider the percentage of winning trades. It can be very, very high. Now the market falls below the red 50. We get the rally right in here, above 60. We drop 5 percentage points. We can buy a put option now right in there. And we would exit right here for almost a wash. Not much going on there. And you can see you want to exit when the rule tells you to exit. There's no sense in hanging on a put option if the market has the potential to rally like this, turning a small profit or a break-even trade into a big loser. You don't want to do that. So never be wedded to your position. Just because you have a position doesn't mean the market has to make you a profit. So you've got to be vigilant in applying these exit rules. Okay, and then you just wait for the next opportunity. The market rallies, it's still below the 50. And you wait for the percent K to drop 5 points right there. You buy your put option right in here, and you get a dramatic drop in a couple of days. You could have exited right on down here for easily triple digits. Again, if you see that happen, if the market gives you a gift like that, take it. Don't wait around where it just plummets like that in one day. Yeah, it went lower, but you don't know that that's going to happen back at this point in time. Then you wait around, you see if we get above 60. No, we didn't. Over here, we've got the market just above the downward sloping 50 moving average. The percent K is turned down, and the market's now closing below the 50. This is a higher risk trade at that point, but you could have bought 1 or 2 strike in the money put and had a pretty nice profit right in here. You exit that trade. And likewise again here, you could have bought a 1 or 2 strike put, and in this case, a very excellent trade. And so on it goes. All right, let's look at one more. Okay, let's look at PFE, Pfizer. Here's the 50-day moving average. Percent K right here drops below 40. Ticks up at least 5 percentage points. You buy your call option here. Market chops around, goes nowhere. And then our percent K moves on up above 60. And we start looking for our exit point. We get a close below the previous day's low, and we're out right there. Another opportunity to get in here. The percent K is back below 40. It ticks up. We're back above the 50. You buy your call option here, and you've got an easily triple-digit gain here, exiting right up here. I hope you're starting to get excited. Scrolling forward, we get a percent K below 40 right in here. We buy a call option. A lot of choppiness here, but we would have gotten out. Regardless of where you got out, it would have been a profit. Not a big profit, but nevertheless a profit. Then the market sells off below the 50. It moves up above 60 on the percent K, and we get a chance to buy a put option right in here. Again, a lot of choppiness going on. Another chance to buy the put here for a pretty nice profit. Then we got the market rallying above the 50, percent K below 40. Moves up, you buy the call option for a small profit. And that's how you trade the simple trading method on the S&P 500 stocks that average less than $40 a share. It gives you the chance to buy the lower cost options. There are many, many, many setups so that it should be fairly easy to be able to, on average, enter into 2 new trades a week. Before we close out, I want to go back to the brokerage site and look at the option table for Micron Technology to make sure you understand how to read these tables. Okay, let's circle back now to the Options Express option chain quote page. And I've typed in symbol MU. And we're going to look at the calls, the November expiration, view the chain, and it brings up all